Good afternoon, everyone. This is Jeff Johnston. I am joined today by John Brown, who is the Director of Financial Aid for Capital University. Many of you, if you've attended training of ours in the past, might recognize John's name as having previously worked in federal loan servicing. You'll note that a lot of what we're going to talk about today relates to federal loans and questions that we dealt with in our prior careers, both of us. I will simply say that between the two of us, John and I have over 30 years of experience in federal loan servicing. And so though we're not necessarily in that field now, I think we have a feeling between the two of us of all this otherwise useless knowledge that we can share. Be silly not to share it. So if you're here on some level, you're talking with families, you're talking with students about how to pay for college, okay? And that if you kind of plug yourself into the timeline, they've applied to all their schools. If they haven't pressed the final application button on some of the regular decisions, they will soon. Some have already received award letters. Some have already received, admittance to the school as well as an award letter. Others have heard nothing from the school. So they're sorting through this process right now of where I'm going to attend. And at some point, all of their free money is exhausted, right? So you've attended our other training. John and I are here representing OASFA. OASFA is we're the Student Financial Aid Administrators Association for Ohio. And think of it as the financial aid counterpart to OACAC, which is for the admissions counselors, for example. These slides are for you. We're assuming you're either new to financial aid, or you're an admissions counselor, or you work in Access, or you work as a school counselor, high school counselor. And again, in some capacity, you're helping students through this process. We create these slides for you. If you're ever going to use them, we recommend you ask us, simply to make sure that they're still relevant. As a little foreshadowing, I would say that these slides are relevant through to about, let's call it May. And then there'll be some updated rates and everything like that that'll change. Here is an email address for you where you can reach the outreach committee. And then this URL, oasfa.org. So if you were to go www.oasfa.org, you will see that there's actually a page for counselors. I will post these slides after today's session on that site. Sometimes it takes till the end of business to get them to appear. So if you don't see them today, you'll likely see them tomorrow. So again, slides are for you. The presentation is for you. And what we're trying to do is help those families make a decision where not only they're going to a school that makes sense to them from everything else that they're interested in beyond the financing aspect of things, the location, that fit for the student, if they're an athlete, the fit with the program that they're going to be competing in, but we want to make sure it's affordable. So what we kind of have is a counseling framework that I've utilized in my career that seems to be successful in helping families break this down. We're going to then turn it over to John. John will leverage his many years of experience to kind of talk us through federal student loans. In particular, some of the things that I know counselors, as far as being experienced in talking with students about, income-driven repayment plans, and then forgiveness programs, and some questions that they might get about those programs. And then also just talking about gap financing strategies. Okay, once everything's exhausted, how do we pay for college? I think then we'll kind of just launch right in. I should also say that if you have any questions along the way, you can see my name here. My email address is jeff.johnston@salliemae.com. jeff.johnston@salliemae.com. I didn't write it on the slide. I should have. If you have any questions during today's presentation, go ahead and email them to me, and we'll address them at the end. Going forward, if you have any questions, again, here's the outreach email address. And several of us monitor email that come in, and one of us will get back to you with any questions that you have related to financial aid. So, again, why I think it's important to have a counseling framework is that this is how America is paying for college. This is a slide that I always use to kind of talk with folks about the complexity of this whole thing. This is based on a survey done in 2009 that would look very similar if we did it today. In short, there are a couple of dozen different ways that folks are paying for college, and families really truly believe in the value of college and are really willing to stretch themselves in order to get their student through the process. Here's a little bit cleaner version of that slide that starts to break it down into subjects that we can kind of talk about. And certainly over here in the green, we've got scholarships and grants at 35%. We have parent borrowing and parent income and saving totaling about 31%. And then if you total the students' contribution along with their relatives and friends' contribution, that's about 34%. Okay, so it's typically students, parents, and scholarships is the answer to the question of how America pays for college. And I think the key then, as we counsel families, is how can we help them make decisions to where this is affordable? And by affordable, I mean before, during, and after. And I think sometimes families, in their effort to get this kid through the process, don't think about affordability after. And I'm always trying to get them to think about their big picture, their long-term experience with their decisions that they make now. So I always say to families at my high school nights that I do here in the greater Cleveland area, look, there are 3 ways to pay for college. We can pay before, during, and after. And that's it. And I usually get a chuckle from the crowd with that line. But the point is I'm trying to give them ways to file information as they learn all of these different things. Every one of these things on this slide can neatly fit into this before, during, or after sort of framework, okay? So as we plug into this timeline, soon students will have award letters from maybe 2 or 3 or 4 schools that they're considering. So remember, the award letter is it's going to disclose to that student all of the financial aid that's available to them. They already have, in many cases, what I think of as a merit scholarship letter, where the school has sent them, in addition to letting them know, hey, you're in school, they've sent them a scholarship letter to say, hey, congratulations, you've got 2 or 3 or 10 or 20 or 30,000 waiting for you here at XYZ University. And that's a merit scholarship typically. The award letter is going to have everything on it. It's going to have the need-based aid. It's going to have the merit-based aid, as well as potential loans that they can consider. And the idea is that as they're considering these things, to me, we still have some before opportunities that we can consider because school doesn't start until September. So the conversations that occur in my house, I've got a high school senior, number one, we can work as students, and certainly students are capable of working now while they're in school, very much capable of earning money while they're in summer, over the summer. My experience has been that watching my older student go through the process, and she's graduating from college this year. So I've got one graduating from college, one graduating from high school. She earned more money each of the last 4 summers. And she's done a great job figuring that out. Remember, students can earn money 6420 without it impacting their EFC. Okay, so over $6,000 can be earned without that student's EFC increasing. And for a high school kid, it is very difficult to earn more than $6,000. Okay, so by all means, encourage students to work. They can certainly save money in other ways. Many kids have graduation parties. At least in my neighborhood, it seems to be a real big thing, and they can leverage those types of monies to help them pay for college. I still think it's a missed opportunity for students that don't consider taking some summer classes, especially given how easy it is to take a class online now and knock a credit out. If you think about knocking a credit or two out every summer over the next 4 years, that's basically going to be a semester's worth of college that will transfer into most of the schools that your students are matriculating to. And then, parents, I participated in a webinar with College Advantage recently, and they were talking about this planning opportunity with 529 plans, where remember now in Ohio, if you contribute to the Ohio 529 plan, you can get a $4,000, it used to be $2,000, $4,000 annual tax deduction for your Ohio taxes. And that's something that parents can kind of utilize not only this year, but next year and the year after, even while the student is still in school, as a tax reduction strategy. During school, once students are actually at school, obviously filling out the FAFSA, you all do a great job. Ohio, it does a great job of getting the word out there about the importance of the FAFSA. Remind them it has to be done every year. Students can work either formally through work study at school, but again, the job of paying for college does not end there. In the summer, you can take these summer classes I spoke about, and summer jobs can be so important. And then some winter breaks at schools are 4 and 5 and 6 weeks from the end of finals until school starts again. And I think it's a missed opportunity to not have something lined up for income during those periods. Parents can take advantage of what are called tuition payment plans. These are where the school says, if you agree to make payments monthly this semester, we'll credit you right now as having paid that full amount, and therefore you're considered on time, and there's no interest to do that. So let's just use round numbers to make my math easy. If a family owes $5,000 and they commit to 5 $1,000 a month payments, well, that $5,000 is credited to the student's account as being on time, and there's no interest to do that. There might be a small fee to do it. And then tax credits. I'm not your tax advisor. I'm not suggesting you become anyone else's tax advisor, but for families that are not aware of the American Opportunity Tax Credit, you'll be doing them a big favor if you tell them about it. And this is the credit where the first 4, if you're income eligible, meaning that you don't, quote, make too much money, the first 4 years that your dependent student attends college, the first $4,000 that you spend as a parent on behalf of them can be credited back to you in the form of a tax credit at $2,500. So I spend $4,000, I get a $2,500 tax credit. That's a really fantastic. So you've created $16,000 of access over 4 years for 10,000 hours of credits, meaning your net out of pocket was $6,000 on that tax credit. And again, that's a credit, not a deduction. That's actually a dollar for dollar tax credit. So the American Opportunity Tax Credit is worth at least mentioning to folks as another strategy to pay for college. And then we're primarily going to be talking now about after, and I'll be shortly turning it over to John here. But the idea here is that at some point in this process, we will have exhausted, you'll have your scholarship night. You'll see the kids that have won those scholarships. They will have full disclosure about what their actual cost to go to school is. So now we need to figure out how to pay for college. And that's where loans come into play. And again, loans, perfectly logical, reasonable way to pay for college. I'm going to derive benefit from going to college over the next 30, 40, 50 years of my working life. So it's totally reasonable then to pay off years of my investment over those working years that I'm deriving that benefit from. So we typically in financial aid, we plug in federal student loans first, and that would be direct sub and direct unsubsidized loans. You'll note that there's not a standard nomenclature for this, unfortunately. meaning that when you are looking at award letters, sometimes you just see them referred to as sub or unsub or direct loans. Some still refer to them as Stafford loans, even though that's a term that's kind of gone away. So they're all referring to the same thing. These are loans in students' names. Typically, after you plug in that first amount, families consider the Parent Plus loan. That's a federal loan in the name of the parent, versus a private loan, which can be either a parent loan or they could consider co-signing their student's loan if they want more of a shared approach. Other financing we'll touch on. I'll come back after John talks about federal loans, but typically most reputable counselors will plug in federal loans first, direct sub and unsub, before we start talking about the other gap financing. So we'll go ahead and we'll start there. And with that, I'm going to turn it over to John Brown.
Okay, Jeff, thank you. Can you hear me?
I can, yes.
Okay, sorry, I figured you probably muted quickly, but I just want to make sure you could hear. So I'm going to talk about the federal loan programs and about the different characteristics of those loan programs, and then also repayment plans, so that you can better familiarize yourself with that information in talking with families. So as Jeff mentioned, there's two loans essentially that would be in the student's name: the direct subsidized loan and the unsubsidized loan. And they are, as the slide states, two separate and unique types of loans that are awarded independently of each other. And so what that means is that when we at the school will do a calculation, we'll determine which portion of the loan can be subsidized and which portion is unsubsidized. There are annual limits, and one of the future slides I'll explain what that means, but there is a calculation that's done for that. The subsidized loan is based on financial need. So when Jeff was referring to the EFC, or the expected family contribution, we at the school will take that number, subtract it from the cost of attendance for an academic year, and what's left over could be or would be the student's financial need. It's possible that a student would demonstrate zero financial need. The entire cost of attendance could be their financial need. And then as we subtract out other forms of financial aid, we reduce that need down to whatever calculation we do for the subsidized loan. For that loan, the interest rate is, it's a fixed interest rate, but it varies every year. And sometimes that can be confusing for families. And what that means is that every year the interest rate is going to change. So each year they recalculate the interest. It's effective July 1st each year, calendar year, and goes through June 30th of the following year. Just something of note, it's based on a 10-year Treasury note and as the index plus 2.05%. The maximum interest rate would be capped at 8.25. And as you can see from the slide, based on that calculation, it's 5.05% for this current academic year, the 18-19 academic year. For students that will be starting next fall, in most cases, unless they take classes in the summer, they'll be borrowing at the new rate that'll come out in typically around May is when we hear about it, but it goes into effect July 1st.
John, as you transition to unsub, with apologies, there is a mistake. My bad. It's actually supposed to be 5.05 on this slide, because for undergrads, the unsub is the same rate. It's for grads that it moves to 6.6. So I'll fix that when I send the slides out. Just wanted to make that point.
Great. Okay, thank you. And that's an excellent point. As Jeff mentioned, with the unsubsidized line, so again, we do that calculation. The amount that can be subsidized would be at 5.5%. The same is true for undergraduate students that are receiving the direct loan. It would be 5.05%. for the unsubsidized portion of the loan as well. The key difference between those two loans is that, just as the name implies, a subsidized loan means that the federal government is helping to subsidize that loan. So the interest that is accruing during the time a student is in school is being paid for by the Department of Education. For the unsubsidized loan, just as you would imagine, it is not. And again, on the example of the slide that we have here, it would be accruing at 5.05% for that population of students, the undergraduate students. The key thing to remember with that as well is that students have the option of paying that interest while they're in school, but they're not required to do so. So it basically creates a separate column in the servicing process where the servicer will calculate that interest while they're in school. If they make payments on it, they'll reduce it by that amount. But then when the student goes into repayment, they'll add any interest that hasn't been paid to the principal portion of the loan. So in terms of the dollar amounts, it's based on the class year or their rank in school. So a first-year freshman can borrow up to $3,500 in the base amount. Now, and again, I don't want to lose anybody, but in terms of that calculation, it could either all be $3,500 as a subsidized loan. Based on the math, it may be a portion of that is subsidized, but a first-year student would never receive more than $3,500 in a subsidized loan. And then the same for sophomore, junior, or senior. Excuse me. It increases to $4,500 for a sophomore, $5,500 for each year as a junior and senior. There is an additional unsubsidized amount that students can receive, and that will always be unsubsidized. So if they choose to borrow that, that's always going to be an unsubsidized portion. But the last column you'll see is the max amount that they could borrow through a combination of both. So that's the annual limits that I mentioned earlier. One thing to keep in mind is that independent students or dependent students whose parents have been denied a PLUS loan are eligible to borrow additional unsub beyond that $2,000 that's listed in the column there. They can borrow $4,000 as a freshman and a sophomore, and up to $5,000 as a junior and senior. And again, the important thing to keep in mind is that the amount that they can borrow will increase each academic year that they advance. A portion of it potentially being eligible as subsidized, and then a portion unsubsidized, and we'll do that calculation. Again, the base amount will always be the maximum that they could receive as a subsidized loan. Go ahead and change the slide if you would. One other aspect of the federal student loans is they do charge origination fees. So a subsidized and unsubsidized loan is being charged at 1.062%. Those fees change each year on October 1st, so they can adjust. The Parent and Graduate Plus loan, which is the loan that's in the parent's name, or for graduate students, there's a Graduate Plus program. They get hit quite a bit harder with origination fees, with their origination fee being 4.248%. So that's the key difference between those two. It's important for students to know that, again, as a subsidized and unsubsidized loan, it's not a truly significant amount, other than it reduces the amount that they're actually getting applied to their bill or applied to their account at the school. With a Parent Grad Plus loan is definitely more. So I always like to make sure that they're aware of that, because if they're trying to get everything down to the penny, they're going to want to know that the amount that they receive will be a little bit less because of those fees. Okay, next slide. So the process for applying for the direct loan program is to first complete the free application for federal student aid. Again, as I mentioned, we need to determine eligibility for either subsidized loans or unsubsidized loans. There are some caveats where different loans, there's different ways of reviewing that, but typically everybody that you would work with, we would want you to be recommending or encouraging them to complete the free application for federal student aid, not just for loans, but for the other types of federal and state aid that they might be eligible for. Typically, what schools will do is receive that information in, they will put together an award letter and send that out to families. And in that award letter, it will explain to them what they need to do to apply for their federal loans. We at Capital, we will list the eligibility for each loan type as part of their award letter, and then let them know that if they wish to borrow, the next step is to go out and complete the entrance counseling, which is a federal requirement. Everybody that borrows has to go through the entrance counseling, and then they also sign a master promissory note. If they attend the same school for 2 or 4 years, or because it's a master promissory note, in most cases, once they've completed the entrance counseling once and that master promissory note, it's good for up to 10 years. But they can complete that process, and that's the steps that they need to do. Now, some schools may ask a student to contact them and say, yes, I wish to borrow, and here's the amount that I wish to borrow. Other schools like Capital, unless you tell us that you want less than the full amount, we're going to process the loan for the amount that's on your award letter. Kind of the gatekeeping process is, did you complete entrance counseling and did you complete the master promissory note? If you've done both of those things, we're going to make an assumption, unless you tell us otherwise, that you want the full amount of the loan. Some schools will do a little bit differently and ask a student to actively confirm how much they wish to borrow, and the fact that, hey, I've gone out and I've done the process, the counseling process and the promissory note. Please process the loan for me. Okay, next slide. So once a student has borrowed, whether they borrow each year that they're in school, or if they borrowed their first year and not again, while they're in school, they qualify for an in-school deferment. So for subsidized loans, they do not have to make payments at all. As I mentioned earlier, the interest is being paid by the Department of Education. For the unsubsidized loan, the payment itself is deferred, interest is accruing, but then they will, at some point, when they cease to be enrolled, at least half-time. So if they, the goal will be that they graduate, but if for some reason they drop below half-time enrollment, and for undergraduate students, that's typically 6 hours. It can vary by school, but typically 6 hours. They'll go into a grace period, which lasts 6 months before they have to go into repayment. During that 6 months, their servicer will be reaching out to them and providing a wealth of information about the next steps for them as they go into loan repayment. And one of the key things that they cover is selecting a payment plan. Every loan has what we call a standard repayment plan. The standard repayment plan for the sub and the unsubsidized staffer loan is 10 years. So a borrower would be able to make a monthly payment for 10 years to pay that off under the standard repayment plan. Oftentimes, students that get out of school may decide that standard repayment plan might be a bit too high as far as the dollar amount that they've come up with. So in the I'm trying to even think how many years, in the last 10 years or so, they've looked at a variety of different ways of enhancing that repayment process, so that students that can't make a monthly payment that's tied to that standard monthly payment will be able to adjust the monthly amount that they borrow. So one of those are what we call income-based repayment plans, or IBR. There are a number of different income-based repayment plans that we'll discuss here. The thing that I think is extremely important for you to understand is that there are income-based repayment plans available. You do not have to become an expert in this. Even for me, working at a school and the counselors that I employ through my office, we can't necessarily be the experts in this field. So we know a lot about it. We want to make sure that borrowers are aware. But the important thing is that they really need to talk with their federal loan servicer to explain their situation and determine what is the best repayment plan for them. So I'll talk a little bit about the different income-based repayment plans, but I say that to say, don't feel like you have to become an expert and know that in order to qualify for one plan, you have to have annual monthly student loan payments that exceeds 15% of the discretionary income, for example. That's not something that you need to understand, just making sure that you know that there are different payment plans. But with the IBR, there is an expectation that borrowers experiencing a financial hardship. They qualify because their monthly student loan payment is greater than 15% of their discretionary income. If they're eligible for this program, their monthly payment will be determined based on a formula that takes into account how many people live in the household that they're currently in. So if it's just the student, or if the student is married and they have family members. And then they'll also look at adjusted gross income. It can increase in amount, increases in the income will impact the required monthly payment. So what we're basically saying is that once you qualify for this program or any of the income-based programs, they will ask you to provide tax information to verify your income each year. So if your income goes up from one year to the next, then your monthly payment could go up. With this program, any unpaid balance may be forgiven after 25 years of scheduled monthly payments. And so what that means is that, as I mentioned earlier, the standard plan is 10 years. With income-based repayment plans, it could extend the life of the loan, so it extends out the number of months that you can pay. Again, with any loan, the longer you take to pay or the lower your monthly payment is, the more you will end up paying in interest. But these are certainly safety valves that are available for families. The next one we'll talk about is the pay-as-you-earn. So if you, thank you. Again, and this is where it would be easy to kind of get into some of the weeds, but with this program, as you can see from the slide, the eligibility for this is only for new direct loan borrowers, except for parents. The Parent Plus loan does not qualify, that are experiencing financial hardship. Again, that's a key component. As you can tell, when they identify it as a new direct loan borrower, they're looking at somebody that did not have a loan balance as of October 1st, 2007, and they received their first loan on or after October 1st of 2007 for the first one, and after 2011 for the second one. So again, great deal of detail. Most anybody that you would be working with would fall into this category, but you don't need to be, you don't have to memorize these types of things. Their loan servicer will help them identify what programs they're eligible for. Just as this mentions, the one key component is that the monthly income is 10% instead of 15%, so it's a lower threshold. Similar to the IBR, the monthly payments will be determined by family size and adjusted gross income, and is evaluated each year. In this case, any unpaid balance may be forgiven after 20 years of qualifying payment, as opposed to 25 years for the IBR. It's important to note as well, as you talk with folks, that any portion of the loan that's forgiven under the pay-as-you-earn and the revised pay-as-you-earn, which will be the next one we talk about, is taxable. So the portion that's forgiven is taxable, and they would have a tax liability for those dollar amounts. Okay, the next one is revised pay-as-you-earn, and again, this is the available to any direct loan borrower with an eligible loan type can choose this plan. And so this again is the next iteration of that pay-as-you-earn program we just discussed. 10% of the discretionary monthly income, same thing, they'll evaluate it, evaluate your income each year on the anniversary of when you started into that program, and then they'll determine your monthly payment. With this one, unpaid balances may be forgiven after 20 to 25 years of qualifying payments. So, and again, it is taxable. So, as I mentioned, one of the things that's important to know about these payment plans is that if a person is struggling to make payments under the standard repayment plan, there are other options available. Unlike most every other loan out there in the world, federal student loans offer different payment plans and offer benefits that aren't available under other types of borrowing. One of the things that's important to keep in mind as well when it comes to these income-based repayment plans is there is a program, and I'll talk about it next, is there's a public service loan forgiveness program. And this started, I believe it's now about 10 years old. And basically what this is allowing for is that folks that have borrowed and are working in a public service or a qualifying organization, and I'll talk about what that means in a second. But if they work in a public service area as part of their career, then they can qualify for a loan forgiveness program. Now, the student has to make, or the borrower has to make 120 qualifying payments. And as I mentioned, if they're in the standard repayment plan, that would be their entire loan would essentially be paid off, barring any unusual payment issues. But the bottom line is, in order to qualify for the public service loan forgiveness, or in order for it to make the most sense, borrowers need to be in one of those income-based repayment plans that we just discussed. So with the public service loan forgiveness, once they've reached 120 qualifying payments, they have the ability to forgive the portion of the loan. So that through that public service loan forgiveness. According to the IRS, the forgiven amount is not treated as taxable income. So unlike those forgiveness things that the features that we just talked about for the other programs, they are not taxable through public service loan forgiveness. One of the things that they have to do, and next slide, is to work at a qualified employer. And the qualified employer would be any government organization, 501c3 not-for-profit organizations, and then other not-for-profit organizations providing specific qualifying services. And so basically what that means is there's a website that will provide information about that, and I'll show you that in a couple of slides that talks about that. But the key things to keep in mind with this is that it doesn't matter what the borrower's job duties are, or what they're required to do, as long as they're employed by a qualifying employer. They can work at multiple organizations, so they may have a position elsewhere as well that is for profit, but as long as they're working at a qualifying employer, they qualify for this forgiveness program as well. In terms of the actual payments themselves, next slide, the qualified repayment plans would be the 10-year standard, which again is a possibility, but makes less sense for most people because their loan would essentially be paid off. Income contingent, which is one we didn't talk about, but it's for older loan programs, the IBR, the pay-as-you-earn, and the revised pay-as-you-earn. And then basically any other direct loan repayment plan, but that qualifies would be ones that are at least equal to the standard payment plans. The important thing to keep in mind, again, with this program is, in my mind, two things, and as I talk with students now about this, don't ever borrow based on the assumption that your loan is going to be forgiven, because you could end up borrowing, don't borrow more than you need, I should say, assuming that a portion of your loan is going to be forgiven, because programs change, programs can be altered or amended. So certainly we wouldn't want anybody to go into a program or go into borrowing thinking I'm going to work in a public service job or some other means my loan's going to be forgiven. So that's an important part of it. But if they are in this in a public service field and they're making the qualified payments, they need to be aware of this because a portion of their loan could be forgiven at the end of that process. The next slide talks a little bit about it provides the websites that provide information like the frequently asked questions for loan forgiveness. In that section, there's links to different organizations that qualify as far as a qualified employer. It talks about repayment. Again, an important step would be for a borrower to talk with their loan servicer about their intention or desire to get into that program so that they can let them know what steps they need to take. There is also a website here for income-driven repayment program questions and answers, which will provide all the information and again a lot of the detail about the different income-driven repayment programs. And again, you don't have to be in one of those for either public service loan forgiveness or for regular repayment, but they certainly help for folks that are having a difficult time making payments. The next slide talks about provides information for a website that will allow a borrower to do a calculator based on their actual loans. So this is provided by the Department of Education. A student would log in through the studentaid.ed.gov in the repayment section, and it allows them to pull in information from the National Student Loan Data Service or database to provide the actual loans that you've borrowed. So they pull in the loans that a borrower has. They'll do some calculations, and they'll say if you use this repayment plan, this is how much your monthly payment would be. Here's how much you're paying in interest, and here's how much the total cost of the loan would be. So that's a very effective tool for students that once they've borrowed would be able to take a look and see, what is my monthly payment going to be? How much is the loan costing me over the life of the loan? Those types of things. That's the information that I have in terms of the loan programs. I'll ask Jeff as I transition back over to him if there's anything that I either breezed through or didn't explain fully. Please jump in.
Again, fantastic job. The things that jump out at me from a counseling perspective, talking about students, a lot of the students that you're talking to, they're all over the place with their relationship with debt. Some are completely clueless. Some are afraid of it to the point of maybe stopping them from moving forward in the process. And then some maybe are a little too cavalier about it. And the good news is the students will usually kind of tell us where they're at. If a kid's talking about taking a student loan out so they can go to spring break, that gives you a pretty good clue as a counselor that they're maybe a little too cavalier about this. And if they're coming from a house where every time the phone rings, it's a bill collector because either mom or dad owes somebody money, they may have a real negative association with that. So, with this program, just to kind of quickly recap, this is a way a student can now contribute $27,000 to their four-year education. If you go back to the slide here where John talked about the amounts that you can borrow, if you add all these up, it's $27,000. Okay, so that's a lot towards most of our Ohio publics. Just as an example, they're going to cost a kid around $100,000 to attend 4 years, and many of the not-for-profit, the four-year privates will cost a similar amount. So you're trying to figure out how to pay for $100,000 in 4 years. It's a lot of money. But we just solved the problem here of $27,000 of it by the student being able to borrow in their own name without a cosigner and without any credit. There's no credit check on these loans, So, and then I think again with these programs here, we're not trying to take you into the weeds and make you experts, but wouldn't it be helpful for a student who's kind of freaked out about debt to know that their payment can be a percentage of their income, and therefore, if they're unemployed and their income is zero, well, what is 15% of zero? It's zero. So these are great programs to help a student understand and assure that your loan payment will be affordable by very definition when you're done with school. Okay. And I think that's the point of emphasis. And then also, just because there is so much noise about public service loan forgiveness, we wanted to kind of talk to you about those programs. So at some point now, and I'm going to go ahead and talk about paying for college after we've plugged in the sub and the unsub, that 27,000. And again, if you have questions right now, I'll check my email at the end of my next few slides here. I'm at jeff.johnston@salliemae.com. And then any questions that come in, John and I will discuss with you. But at some point now, we still have a gap in many cases, and we have to figure out how to go to school. So anytime I'm contacted by someone trying to figure that process out, the first thing is we have to identify what the gap is, of course, after plugging in that sub and that unsub. In some cases, it'll be just a few $1,000s. And, those are easier discussions because really we can start to talk about using current income through that tuition payment plan to handle those types of smaller balances. But I've talked with people just in the last year ranging from 8,000 up to 28,000 being their undergraduate gap. And that's after plugging in, the sub and the unsub. So, 28 would be 14,000 per semester, 8,000 would be 4,000 per semester. So often the answer is not going to necessarily be one of these things. It's going to be a combination of several of these things. And so for families, it's a discussion around parents borrowing versus students borrowing. Okay, so in other words, the student's already borrowing, remember, the sub and the unsub totaling 27,000. So the question then is, well, parents, are you available to use your current income? And then that goes back to this tuition payment plan. Remember, if they owe 18,000, they don't have to put all of those dollars down on a monthly basis. They could maybe spend $250 a month as an example. And if they did that over 10 months, 5 in each semester, that's $2,500 less now that we have to worry about. So we've gone from 18,500 down to 15,500, right? But Parent Plus loans are federal loans in the name of the parent, and I'll have more comments on that shortly. Many parents are still considering the home equity line of credit. Remember, as per last year's tax law, the home equity line of credit, I'll just say it's almost impossible to use it for school and get the tax deduction. But you can still use it for school. And this is a home equity line of credit. If you don't know what that is, it's for those folks who have built up equity in their home. So let's say that their home is worth $100,000 and their mortgage is only $50,000. Well, that means that they own outright $50,000, or they have $50,000 in equity in their home, and lenders will loan that homeowner money against that equity. It allows you to essentially access the equity in your home to utilize to pay for things. And even though the tax write-off is no longer available, fact is that home equity lines of credit are a good deal typically for those with good credit that have a lot of equity. And for those families, I know we have folks from all over the state of Ohio on this call. We have folks, from wealthy areas and folks that are dealing more with folks who don't necessarily own homes. But for those that are dealing with wealthier, my apologies. For those that are dealing with wealthier families, don't turn off this notion of the value of home equity line of credit just because the tax write-off went away. Private student loans will be considered by many families. The idea is that a cosigner is almost always required for a student that you're counseling that's coming out of high school to borrow money. So in other words, the parent typically, but often it can be somebody else in the family that maybe has established credit, but someone will have to stand in and co-sign that loan for that student. And then new, just in the last 3 or 4 years, are parent private loans, that basically, when you think about the Parent Plus loan, as John noted, there's a 4.2 something percent fee in that loan. So if I borrow 10,000 as a parent in that loan, I'm getting roughly $950 or $9,580 credited to my student's account, but I still owe $10,000. I've paid up front, over $400 in a fee. And many parents balk at that, and that is an opportunity then for the parent to apply and compare with private parent loans. I'm not a big fan of retirement plan loans in general, but they come in two different kinds of situations. Typically, 401k loans, there are families that consider borrowing money from their own retirement plan. The only thing I would say about this is, remember, you can borrow money to go to college and help your kids go to college. You cannot borrow money to retire. So I really hesitate to borrow any money from retirement, because again, I have to retire. The idea is that Roth IRAs are a little different, because the idea with a Roth IRA is that they were originally designed to be hybrid plans, and by that what I mean is people were saving into them to both save for their own retirement and their kids' college, because they could access the principal to help their kids go to college later in life. So some of those early on that were set up 20 or 25 years ago, it's a logical strategy. And again, families will consider using those. So for me, what I'm doing here is I'm plugging in, when I talk to families, I'm plugging that 27,000 in. It's 5,500 for this first freshman year. I'm saying it in that way because I want them thinking about their big picture. If they owe 18,000 this semester, and they put it all into a private student loan, well, I'm trying to get them to do that math, okay? Because 4 times 18,000 by my math is going to be over $75,000, and we're borrowing 30,000 in federal loans. If that kid's going to be borrowing $105,000 to go to their undergraduate program, they better be coming out of a really highly rated engineering program for that plan to work. So in other words, I'm not saying that plan won't work. I'm saying that you have to connect their future loan payment to their earnings. Because remember, private student loans do not have the eligibility for the forgiveness programs John discussed, okay? So, with private student loans, if you borrow 18,000, you are paying 18,000 back. Now, again, they have co-signers on them to assist them as needed, okay? But I'm connecting their future loan payment to their earnings when I answer the question, hey, someone will ask me, do you think this is an affordable plan? I'm going to counsel an engineering major different than someone maybe who's going into, let's say, the teaching field, where I'm working now with several young teachers that are 23. They've just come out of their program, and they're subbing right now, looking for full-time work. I have a pretty good idea of what teachers start at, and I can tell you with what teachers start at, it's going to be really, really difficult to make payments on $105,000 worth of loans. So you've got to keep in mind what they're studying as it relates to affordability. Here's the Plus loan again. This is the loan that really becomes an effective tool for families that are concerned around credit. So when considering the Parent Plus loan, you can see it right there. You can see the fee. We've talked about that. But some people get nervous about, look, at my EFC is $8,000. I don't have $8,000. Well, you can use the Parent Plus loan to pay your EFC, okay, as a parent. And then as far as the credit check, they're just looking at credit history here. They're not looking at debt to income ratio. They're not looking at, for example, your credit score. Okay, they're just looking to see if you have negative credit that's late, more than 90 days late, and they're looking to see that it had to be over 2,000 hours worth. So I think it's actually 2080 specifically, 2080. So the point is that folks that say to you, hey, I don't know if I can help my kid to go to school because my credit isn't that good, the Parent Plus loan can be the answer, okay? Because they may pass the check, the credit check for Parent Plus loans. So for those families that are on the higher end and they're concerned around the fee, often they'll apply and compare with private student loans versus the Parent Plus loan. For families that don't necessarily have the great credit, they don't have a great debt to income situation, they'll often focus in on the Parent Plus loan, okay? And again, the idea is that in case you're wondering if there are any other solutions coming shortly to help families out, I kept this slide in here. This is a slide that was originally put into a training presentation that OASFA put together 8 years ago. And can anyone tell me if I had to alter this at all? So we're waiting on what's called reauthorization, which is the reconsideration of all of the paying for college programs. The original Higher Education Act in 1965, what it said was, hey, we're offering all this money to help kids go to school. We should really check in on it every 5 years to make sure that money is making school affordable. And I think this is our 9th year, if I remember correctly, that we are waiting now for authorization to happen. Right now, what we've shown you is what we expect for the students that you are counseling. I'm going to check my email in just a second. While I'm waiting to do that, a couple of things. If you received an invite to this training, you are already in our contacts database. If you did not, if someone forwarded you this link to come and join us for this, please go and register yourself. You go to this website, under resources, you'll see that there's a counselors page. That is your page. That is also where you'll see this presentation and a recording to the webinar up there. Again, you can reach us at outreach@oasfa.org. I will quickly check to see if any questions have come in. John, do you have any final comments?
No, just other than thank you for your time and attention today. And again, if you have questions, and you email them to Jeff. If you think of questions later and it was something for me, Jeff will make sure that I get that and can answer any questions you might have. But again, thank you for the time of being here this afternoon.
Yep, and I again thank you as well. Thank you for helping students through this process. And we appreciate your time today. Don't hesitate to reach out to us, whether it's this email or mine, if you have questions going forward. Thank you very much. This concludes our webinar.